Okay, so let's talk about something that's been quietly brewing in the world of finance. It's all about those big, shiny office towers that make up our city skylines. We're talking about commercial real estate, or CRE, and the incredible pressure it's putting on the US banking sector. But here's the thing, there's a really strange paradox at the center of it all that we need to dig into. Right, so here's the puzzle. You've got all this anxiety about a commercial real estate crash, but when you look at the official reports from regional banks, the very banks that are most exposed to these loans, they're basically saying everything's fine. In fact, some are even reporting that their loan performance is getting better. So what gives? Are they just immune to all this? Or is there something else going on that we're not seeing? And this chart, it really lays out the mystery perfectly. Just take a look. That blue line? That's the large banks. You can see their CRE loan delinquency rates are climbing, and fast. But now, look at the orange line for the regional banks. It's just flat? It's almost shockingly stable. I mean, on paper, it looks like they're operating in two totally different worlds, but they're not. So to really get to the bottom of this, we need to compare the official story with what's actually happening behind the scenes. It's really a tale of two different banking realities. You know, Reuters recently looked into this and found that several big regional banks have been reporting falling rates of non-performing CRE loans. They're telling everyone they're de-risking and that their credit performance is improving. So if you just looked at these official numbers, you'd think, oh, okay, I guess the CRE crisis for regional banks is totally overblown. But if you did that, you'd be missing the real story that's hiding just under the surface. So how did we even get here in the first place? Well, this intense pressure on commercial real estate didn't just pop up out of nowhere. It was really created by a perfect storm of two massive shifts in our economy. It's like a classic pincer movement, really. On one side, you have this huge structural shift in how we work. You know, the pandemic made remote and hybrid work totally normal, which means companies just don't need as much office space anymore. That's a fundamental hit to demand. Then, on the other side, you have the shift in monetary policy. The Fed started aggressively hiking interest rates to fight inflation, which put an end to more than a decade of super cheap money. All of a sudden, borrowing got way, way more expensive. And wow, you can really see the impact of that demand shock right here. Office vacancy rates have just soared, hitting a record 20.1%. I mean, look at that green line just climbing and climbing. This isn't just some temporary dip, you guys. This is a structural change, and the office sector is basically ground zero for the entire CRE problem. And all of this, it leads us to the real heart of the conflict in our story. A massive, and I mean massive, amount of debt is coming due at the absolute worst possible time. It's creating something the industry calls a maturity wall. So what exactly is a maturity wall? Well, it's pretty simple, actually. It's just a huge spike in the amount of debt that has to be either paid back or refinanced all at once. Think of it like an entire graduating class of loans suddenly needing a new job in a really, really bad economy. And the scale we're talking about here, it's just staggering. In 2026 alone, nearly $1 trillion, $930 billion to be exact, in commercial real estate loans are going to mature. This isn't a ripple in the pond. It's a tidal wave of debt heading straight for the shore. And this is where the math just gets brutal. So imagine a property owner took out a loan back when interest rates were, say, 3%. Now, in this new environment, they need a new loan, but rates are more like 6 or 7%. At the exact same time, their building is worth maybe 30% less. So the new loan they can get is way smaller than the old loan they have to pay off. And that gap is the crisis right there. Okay, so if the math is that bad, why do those charts for the regional banks look so good? This is where we start to solve the mystery. We're going to uncover the risk that's basically been hiding in plain sight. Well, the answer lies in a tactic called extend and amend. Basically, instead of forcing a borrower into default when their loan is due, a lot of banks are just extending the deadline. They're kicking the can down the road, pushing these problem loans into 2026 and beyond. Now, this is great for their books today. It avoids a default, but it doesn't solve the underlying problem at all. It just delays it and makes that 2026 maturity wall even bigger. And this is the crucial point, the difference between what's being reported and what's really happening. You know, researchers at the Wharton School have a great term for this, latent distress. These are loans where the property is already worth less than the debt, even if the borrower is technically still making payments. And what they found is that this hidden, latent distress is 4 times higher than the official delinquency rates. So that stability we saw in the charts, it's not a sign of health. It's a sign of delayed pain. So, why does this matter so much for regional banks specifically? This chart tells the whole story. For smaller banks, CRE loans make up almost half of their entire loan portfolio. Just think about that. Now, compare that to the biggest banks, where it's only about 13%. Regional banks are the absolute backbone of CRE lending, which means if and when this latent distress becomes real, they have nowhere to hide. All right, so what does all of this mean for the future? Well, the general consensus isn't that we're headed for a sudden explosion. It's more likely to be a long, drawn out period of adjustment. The outlook is for a slow burn. And this quote from the NYU SCAC Institute really sums up the outlook perfectly. Nobody's really expecting a dramatic 2008-style systemic collapse. Instead, you should think of it more like a prolonged, painful correction that's going to play out over the next 2 to 3 years as that maturity wall finally starts to hit. So, as all this plays out, there are three key things you're going to want to keep an eye on. First, what does the Fed do with interest rates? That's huge. Second, how hard will regulators push banks to build up their capital reserves to absorb losses? And third, what's the actual pace of foreclosures? That's going to be the ultimate sign of how quickly the slow burn is progressing. So here's the bottom line. That strategy of extend and amend bought a lot of time, but it didn't solve the problem. The correction that's been delayed for so long is finally arriving. And the big question now isn't if it's coming, it's who is truly prepared for the slow burn ahead. This is not financial advice.